time to introduce yourself.
All right, thank you for having me, guys. It's a pleasure and nice to meet you all. Thanks for your time. As Mike said, my name is Jake Lord. I am a co-principal of Wedgewood Capital Group. We have a subsidiary property management company named Ethel Street Management. We focus our business in the Lehigh Valley. We currently manage about 300 apartment units in the Valley and a little bit in Reading, so in aggregate about 300 units. And then we currently own 43, and that's across 3 buildings. We've gone from starting with a single family home to now buying mid-sized multifamily. And our focus right now is the Lehigh Valley. We'll ultimately expand to probably Philly next as opposed to any other markets, just because of the connections that we have in the business. But yeah, I mean, born in Delaware County, families from Delaware County, raised in Chester County, lived in Baltimore for a little bit, went to Penn State, graduated in 2016. Favorite color is red. I like long walks on the beach and pina coladas. Yeah.
Can you talk a little more about what sparked the interest to start the real estate company and what that specifically looked like?
Sure.
You had, I think it was one of your friends.
Yeah. So my partner, so I have 2 partners. First, like I have one main partner that we had started the business together back in 2019. We were mechanical engineers at Penn State. We knew junior, senior year that we weren't going to be engineers. To be quite frank, I didn't think I was smart enough to be an engineer, and I think he felt the same. So we were more drawn to entrepreneurial tendencies, and we just stayed in touch after we graduated. Just, learning about what we're doing and the companies we were working for, and talking about doing something together. We didn't know what that was, and I had tried to work with my brother and my dad in the real estate game. We went to a seminar, we started a brand, started an LLC, made some flyers, came out of the gate hot, and then that just didn't work out so well. I think it was everybody's interest and passion was misaligned, and Jason and I had talked, hey, let's start something. His dad had brought him into a real estate deal, and I had the experience of working with my dad and my brother, and it sounded like that was the right thing to start, and then see where it went, and we hit the ground running from there, I guess.
Do you start with an operating agreement, and you know what you want to do, set the company, and then start doing that, or did you find a property and then say, all right, we're at a point now where we can incorporate and figure out the business side of stuff?
Yeah, so interesting point on the technicality of the operating agreement, right? Like, what does an operating agreement represent? If we want to talk about, should we talk about partnerships? Like, like what does an operating agreement represent, right? Every business relationship should have a contract behind it, but the people that you work with, especially a partner, if you guys are exploring partners, like I know you guys sounds like you guys are gonna work together just from our conversation. The person you're going into business with, you can look at it as a marriage, honestly. Like, besides the romantic aspect of it, I mean, Jason and I, while we were trying to find our first deal, we're on the phone, I kid you not, every single night for 3 hours trying to figure this whole thing out for 10 straight months until we finally bought something. You want to wring each other's neck at times. You're spending way too much time together, but you got to trust that person. So we had put together some formality of a some janky property or operating agreement, but what did that really stand for? It wasn't until we had formed the LLC, it was technically an S corp because his dad's a lawyer and recommended it. That S corp is still active, by the way. But that wasn't until we had found the property 10 months later that we were going to invest in. And then it's just co-ownership of that business. But there's different ways to do it. I think the foundation is trusting who you're working with.
It sounds like you took some massive action with your dad and your brothers, and we're kind of gung-ho there. Then there's another massive action to start this Wedgewood Capital with your friend. What sparked that, or what did that look like? Was it just calls? And everyone talked about massive action, but when you say you want to go do it, what is it?
Yeah, if we're starting from conception, conception being that first real estate deal. First of all, Wedgewood Capital Group wasn't formed until very, very recently. It's only a year or two old, and we've been in the business for 5 years. Pulling the trigger on that first property is such a hard thing to do because you feel like you don't know all the moving parts, and you're insecure about that. It's just so I'm understanding who I'm talking to. Does anybody here own real estate at the moment? Okay, all right, cool. So we're not working with a bunch here, but so for the guys that have done it before, you know what I'm talking about. I mean, it's a tough thing to actually take that leap, and start, to sign the purchase agreement and figuring out what you're offering and what the conditions are. Is there an inspection contingency? What do you do with the mold and the termites? You have no idea what the hell you're even reading. And you just got to take that leap of faith and know that you put in the time to prepare yourself for that, and buy something that's not you're not overextending your knowledge and capability. Right.
Well, I think it's a lot of people talk about that fear. Well, there's a reason it's fearful. It's
Yeah.
a lot of freaking money,
Yeah.
and it's sometimes not even your money. So
Yeah.
it's like it can get to that like analysis paralysis, because it's like I want to make sure I don't screw up anything, and I think that you probably had a lot of those fears.
For sure. Yeah, especially in real estate. I mean, there's a ton of tire kickers. It's such a popular industry, right? Real estate is like, the earth is real estate, right? It's just the foundation of business. So there's so many tire kickers out there that aren't able to go from 0 to 1 and talk about it. So taking that first step is a hard thing to do. It's probably the hardest step we've ever taken. Even still to this day, I'd say it's the hardest step that we've ever taken, is that first one, just to buy a single family home.
Yeah, and I think that's the thing I really took away from the last time I heard you speak, was just how focused you are, because you live in Philly and you invest in Lehigh Valley, and I'm like, why don't you just invest in Philly? You're right there. There's tons of apartment buildings.
Yeah.
But you said immediately, no, I'm focused on Lehigh Valley and I have the connections. So what's the business plan, and how do you contribute a lot of that focus probably to your success?
Yeah, so talking about the market itself, I mean, listen, the angels aren't going to, come down from the heavens and tell you, oh, you got to invest in this specific market, right? Eventually, you're going to have a choice, of the different markets that you want to invest in, and you're going to have to pick one, as long as you're looking at the right metrics about, what the market that you're jumping into is one that has a growing population, has strong infrastructure, education, transportation, right? Those types of things that you're going to look at, but eventually you gotta pull the trigger on one. I mean, our strategy has been to go deep on that one market, because we feel that we have opportunities to look at deals that others don't, when we are deep in that market and understand it very, very well. And as you spend more time in a specific market, you get to meet the movers and shakers, because you're spending time there instead of spreading yourself thin. So you just become more ingrained in that. I mean, listen, we don't know how things will evolve as we expand into Philly. I mean, that's what we think we're going to do. We've explored other markets. We explored Tampa, Florida for a bit. We explored Charleston for a bit. We spent some time down there and really tried to understand that market well, just to see what our other options are. And what we ultimately determined is that the path of least resistance is leveraging the knowledge and the relationships that you have. And real estate is so street by street, right? Like even in a market like Philly, you know, without spending time there or talking to the people there, you may not know that literally one street draws the line between a nice place and a bad place. And by the way, I live on the street that draws the line, so I see it for myself. Washington, not to name any.
We'll cut that.
Yeah, everybody knows it. But it's so colloquial, like you need to know the market very, very well, or you can find yourself buying on the wrong side of town, which we've done before. I was telling these guys, we've made, I think, every single mistake in the book. We bought on the wrong side of town, and that was a nightmare. So, I mean, these are the types of things that you need to learn over time. No one's gonna come to you and give you all that information. Like, you need to seek it out and learn for yourself.
Yeah, that's advice we got not too long ago too. It's just stay focused, because like there's so much pressure to get the first deal or a big deal or the right deal. You start to branch and you start looking at all these different markets, and it's like, I think you're going to have a higher yield of success by just stay focused, stay in the right asset class, stay in the right business plan, and spend that time that you would looking at other deals or markets, and go have a rekindled conversation with somebody you talked to 2 months ago.
For sure. Yeah, always leave those other avenues open, you know, on the back burner.
It's okay to pivot, but don't like just look at everyone.
Yeah, totally. I think there's a lot of throwing spaghetti at the wall to figure out what that market is. But understand them, like I said before, understand the metrics you're using to evaluate that market, and then you just got to pick your horse and ride it. I mean, that's just how it goes.
You kind of mentioned some like tire kickers too, but there's also like there's some shadiness in the real estate business, but not necessarily like
anything business.
Yeah, not even
just society.
But what are some like business plans that you're seeing people do? I think maybe 2 years ago people were just overspending. Didn't matter, they wanted to do their overspending. Now maybe people are doing bridge debt, and maybe that's a little bit even dicey to their business plan. So what are some things that you're seeing that you're just like, I'm not going to go that route?
Yeah, I mean, I think for the beginner, what's important to know is don't change the numbers on your spreadsheet to fit the deal. Change the deal to fit the numbers on your spreadsheet. And those numbers should be ultra conservative. If the deal doesn't work in several different ways, especially as you start out, don't do it. Now that also makes it frustrating because you're evaluating deal after deal after deal after deal. It takes forever to find one, and you're like, hey, like this is ridiculous. Let's get a little bit riskier, and then you can find yourself in a position where, like I was telling you guys before, where you have this bad experience in real estate where you lose your money and then you're sour to the business the rest of your life, when really it was just a bad move to start. So I would say, like, I think we see it more so in syndication, right? Even on a large scale, you look at these deals on like Realty Mogul where they're disclosing their underwriting models, and you're seeing some of the numbers that they're putting into their spreadsheets, and you're like, what do you do? And then they're raising money on it, and they raise money on it from the layperson investor who, I mean, in a multifamily syndication model, there's like 10 different tabs that all feed off of each other. It's such a smoke and mirrors game. And then these guys like Grant Cardone, maybe not to name other names, but like they fool people into investing in their deals, and they say, oh, you could get this great 10% annualized return on, when really that's not even like a good deal. And they make it sound it because of all the marketing and the hoopla, and then you look under the hood and they're doing some shady stuff, and it's just not fair to people. And it's an unregulated, private equity in general is an unregulated, relatively unregulated investment vehicle for people, which is, you talk about accredited investor versus non-accredited. An accredited investor should know what they're getting themselves into, but still, I've gone off on a tangent.
No, it's kind of on the same topic, because it's a weird market. There's starting to be higher deal flow than there was probably 6 months ago. More stuff's coming on market. But so you obviously you manage properties and you also own some of your own properties. So what are some of the things that you're doing right now to kind of either weather the storm or protect your investors' property management? Like what are some of the things you're doing right now to better position them?
Yeah, secure debt, I mean, is going to be your best hedge. And as you invest, you come to learn what secure debt really means. Low loan to values, right? The higher the loan to value, it sounds nice because you're putting less money in, but it's riskier because you need to meet a certain debt service coverage ratio, which I think plays a part more so in mid-sized multifamily with more institutional loans than it does with small multi, where you can default on that loan. These types of things, right? Is it floating rate versus fixed rate? Ideally, you're looking for something that's longest term fixed rate as possible so that you're secure, right? And you're not finding your loan maturing and now you're facing an interest rate that was way higher than what you had signed on for before, and now you're in a bad position and your property's underwater. And then one bad, especially if you're raising money, one bad deal can tarnish your reputation. I think especially for syndicators, which I know that isn't the audience here, but
Well, I think
one bad deal you can kill your career.
It's not just killing the people you lost money. It's also that where it's threats from every broker, every property manager. These guys can't close. Or
Totally. Let alone looking yourself in the mirror and knowing
it's a small world too. Once you start talking to the brokers,
it really
everyone knows everybody.
For sure.
And that counts for out of state, multiple states. They know each other. They all stay connected.
Yeah.
I think we've been talking. One of the biggest things right now to really focus on is just staying connected with investors and even the brokers that you've been touch base with before, because you got to do conservative underwriting. If you're raising money, raise more money, have more reserves, because you just got to be prepared for. Everything costs more than it did before.
Totally.
And that's
costs more and takes longer.
Yeah, it's not just the building, it's the getting the landscaping done. It costs more, it takes longer. So I think it's just, it unfortunately means turning away even more deals than we want to. We want to have that next deal ready for our investors involved, but now's not the time to take the risk, because I think there's going to be more deals to come and you want to be ready.
Definitely,
Yeah.
How do you keep in touch with your investors? Do you send out like a newsletter, or do you send them specific updates on the property at a certain cadence?
Yeah, great question. This is something that's also, I think, just generally in syndication, at least multifamily syndication. I mean, I've dug so much into other verticals of real estate, but like as I said before, the standard has not really been set. So you can be investing in something that seems institutional, and then they're just not communicating with you. It doesn't make any sense because nobody's forcing them to. So it's really just a factor of doing good business, which sadly is a lost art these days. There's people fully with utmost integrity are fewer and farther between. You need to be careful who you work with. But I think there's a lot of under communication in this industry. I don't know if you guys feel the same way. And the way to stand out and differentiate is to over communicate. If something's going down with your deal and you're investing or you have investors, tell them, right? Write it all out. Here's the problem. Here's how we're solving it, right? It's the fundamentals of doing good business. So what we do, to answer your question, we've raised money for 2 deals thus far, and we put out, during the renovation, we put out a monthly newsletter, not a newsletter, a report where it's outlining the details of, like, we're putting our P&L on that. We're talking about in detail about leasing. We put X number of units on this date, and they were leased out by Y date. We had an issue with the cabinets were ordered wrong, and we had to wait another 2 weeks, and that caused delay. And these 3 units not renting out for 15 days. We had to issue a concession to the tenants. These types of details, owners or the investors love to hear that. And then after the investment has been stabilized, we put out a quarterly report during the renovation period also, but then in perpetuity we sent out a quarterly report, and typically that report is just an executive summary, right? Here was our income, it was X percent over or under projected, here are our expenses, X percent over or under projected, total variance of whatever the percentage number is, here's our P&L. That's it, right? It was like a 2-page report for Washington School, our first investment, and the quarterly report for Wolf School, our second one, was like 7-8 pages long with details of what's going on with the deal.
Okay. I think we alluded to it earlier, was one thing that we noticed talking to you several times before this was just your focus on, or your passion, your views on ethics. And we've alluded to a couple things that you can look out for now, but if you're an investor and there's syndicators and you're looking to be an LP or invest in one of these deals, how can you vet? What are some things that stick out as a syndicator might be trying to do some shady stuff?
Yeah. It's such a hard thing to do because, as I mentioned, there's so many opportunities for that GP to play the smoke and mirrors game on you. First, educating yourself, and there's books out there like BRRRR has a book written by, I forget who wrote it. I read it like 6 months ago, but it outlines. It's from the LP's perspective, what to look out for in investors. So educate yourself to start. Talk to other investors that have already invested their deals. Look at their track record. Get to know them as individuals. Are they trying to is it some type of car salesman type of approach to trying to get your money versus I feel like just selling in general. You should be outlining every reason they shouldn't be doing the deal, so that you're setting the expectation. You're under promising and then you're over delivering. That's a key thing for us. We heavily under promise on our deals to protect our downside, especially going into some volatile, market. We don't know what's going to happen with interest rates, and who knows, and then ultimately, I think how things are panning out for us is we'll far exceed what's been projected, and our investors will be very happy. But the proof needs to come out in the pudding once the deal's been done. You shouldn't be trying to oversell them on something, and then when you overperform beyond what you thought you were going to do, not what you were telling them, they're like, okay, good, that's what I was expecting, versus holy shit, I need to invest more money with you guys, this is amazing.
Right. And they'll start talking to their friends.
Yeah.
And word of mouth is huge.
Yeah.
Transitioning to a different phase here, a couple short questions. One, on what you just alluded to, educating yourself. You have a favorite book or a podcast that would be great for someone just getting into real estate?
Yeah, I was telling these guys, I feel like BRRRR has everything you need to know, because they also introduce you to other content, right? They bring on their guests and they ask the question of what's your real estate book, and not 75% of them say Rich Dad Poor Dad, right? But you still hear others, right? You hear these unique answers that you haven't heard before that pique your interest, and you take a look at it, and then it's a valuable thing. I think the foundation for anybody looking to start out is bigger pockets for sure. I personally like to read biographies of founders. Which, speaking of, there's a podcast out there called Founders. This guy, David Senra. Have you guys listened to this podcast? Oh, it's awesome. So what he does is he makes a podcast on a book every week. And at the end of the podcast, he says, 371 down, 1,000 to go, right? 372 down, 1,000 to go, right? It's always, in perpetuity, he's going to be doing it forever. And he talks about these books with such passion, and digs deep into certain passages of the book and this person's life, and it's it's very encapsulating and educational and inspiring to learn about different founders, even if it's not in real estate, because I think good business acumen is translatable to any industry, and you learn that from I think just from learning from other founders in other industries. So, yeah.
What do you think is the most important mentality for a business owner to have, or the best attribute, mental attribute
Sure.
to have?
Yeah, I mean, I think there's like two. Have integrity. Just do good. Just be a good person, right? That should be the basics, and then tenacity, right? Because you're just gonna deal with. I mean, if you're really taking it seriously and you're pushing yourself through it and you don't get lucky, which I don't think sometimes you get lucky, but you shouldn't. I think every successful career relies at some point on luck. When you hear those people talk about it and they don't attribute it to luck, they do attribute it to luck. They say they were lucky, but it was really, at the end of the day, it was their ambition and tenacity. You just need to be willing to keep pulling yourself through the shit. So I'd say integrity and tenacity are the two.
What's one thing that you do that you think facilitates your growth the most?
Focus, which I talked about at the last meetup. Like, I think focus is super, super important, especially today's day and age where social media is pulling you in every direction about what clothes to wear and where to vacation and how to make your money, and like cryptocurrency, which you made a ton of money on, it sounds like, worked well, and now it's like, who knows what's going to happen next, but you have all these different avenues, like where do you, like, you could find yourself, if you listen to social media, you'd be trying to invest, you'd be spreading yourself way too thin, investing in anything and everything, and you become a jack of all trades and a master of none. Pick your lane, focus on it. And investing in real estate is not a lane, right? It's cast such a wide net. You need to focus, even more narrow. Okay, so you focus in multifamily. Okay, you need to focus now on the unit count and what brokers are doing those deals. Who are the wholesalers, even if it's wholesalers, or who are you cold calling, right? Because I think if you're really trying to start out and you don't come across a deal and get lucky that a family member gave to you, or you just so happen to stumble upon, or a realtor gave to you and just so happened to be a good deal, which you shouldn't. You should leverage those avenues, but don't count on them. You're going to find yourself cold calling. You need to narrow the focus. I think that's the most important thing.
I guess the last question that I'm here is, how do people get in contact with you?
Yeah, I'd say for anybody that wants to chat about like what they're looking at and get, collect some advice, just another ear, another person to speak with about the deal, like, or a deal that you may have, or what you're looking at, or an avenue that you may take. Like, I'm happy to have that conversation. I've my business card. We have an Instagram, but like the thing with, I don't know how, like the thing with marketing and social media for us is like pulling chicken teeth. It's horrible. Like we suck at it. We need to get rich enough to be able to pay somebody to do it. Otherwise it's not going to get done. So yeah, we have some Instagram that like 100 people follow, and I post on it because it's, I'm proud of the projects that we do, some cool stuff that we do, but like, I'm not going to go telling my grandma about it, like, it's just, people find us, they find us. I think in my personal opinion, the action needs to come before selling yourself on social media. The action needs to come before that, and then the action speaks for itself. So ultimately, it just naturally flows. But that hasn't worked for us. So yeah.
Awesome. Well, I think that's all we had for the interview. So I wanted to thank everybody for coming. It's great to see some new faces. We're always looking to continue to grow the meetup and NextEra. So if you have any interest in what we do, what we invest in, come talk to us afterwards. Thank us again for the interview.